And I'm going to assume that we are live. Welcome everybody to this gold market update, where we're taking the opportunity to update you on what's going on in the markets and what we see going on in the markets and how it affects gold and silver. I'm just going to, if you just bear with me a second while I share my screen here. Let me just find this now. Yeah. Just get this title slide up for us. This is the title of our video for today: Pandemics, Lockdowns, Fake Markets, Gold and Silver Outlook. And as usual, I'm joined by CEO of Gold Course Stephen Flood and Director of Research Mark O'Byrne, both coming at us from their respective homes. And I see that today Steve is taking the benefit of being outside on this beautiful sunny day. So good morning, gentlemen. How are we?
Good morning, David.
Good morning, David. Good morning, everybody. Yeah, it's absolutely, we're spoiled with the weather here in Dublin at the moment. It's fantastic. And inside my house, it's far too loud with kids. So I think it's the best place to have this is outside.
We all have to do what we all have to do in this day and age, working from home and trying to juggle that with family and family commitments and all. And I'm sure everybody that is listening and watching on here is doing something similar. What we did today, or what we're doing today, I'm just going to stop sharing that, because what we're doing today is we're just going to have a look at a few things that have caught our eyes over the last couple of days or so. And this is an article, Steve, that you wanted to bring to everybody's attention. Let me fix my microphone, getting a little bit of a jitter there. You wanted to bring to everybody's attention stocks increasing pricing and a V-shaped recovery. What if it's W-O or U or L?
Yeah, Mick, this is there's a newsletter writer there. He does Hedgeopia. Fantastic insights into the market. He sends out a piece every day. It's well worth signing up for if you get a chance. And obviously, the big question right now is, given the economic impact of the COVID crisis globally, what does that do to the potential earnings from companies? And if you look at stock markets around the world, they all would have sold off quite aggressively as that outlook deteriorated, and those expected cash flows would have been come under pressure, and so the price of stocks were seen to be too expensive. So the market dived about 30% or something at one stage, and it's bounced back quite a lot. Actually, it was around 20% down, and it bounced back quite a lot. And what you're looking at, V-shaped, U-shaped, W, or whatever it is, what you're looking at, a V-shape would be a sharp correction followed by a sharp bounce. An L shape is a sharp correction, and then a long,
and then go sideways for a long time.
Yeah, you go sideways for an indefinite period of time. Most crises and economic things happen. You'll see a U shape where it's kind of a fairly gradual pickup back to norm. And so what we're looking at the markets today is very much a V-shaped bounce, and it's not a dead cat bounce as many people would have thought, that it would have just sold off again more aggressively and gone down. I think back in the 1930s, you would have seen an 80% plus correction in the stock market in terms of a fall, and it took some time, and a depression before it started seeing improvements. And if you were to scroll down, then Dave, down the page here, there's a particular chart I wanted to show you and the listeners, which I think is really fascinating.
This one, I think, is it?
Yeah, this one here. Basically, what we're looking at here is from the 1970s. The columns are the U.S. nominal GDP. Debt to GDP ratio, and it's tracked on the right hand side there. So those columns show how much debt there is for the annual GDP of the United States. So in the 1970s, you would have seen maybe around 25% of total debt to GDP. And then it started to rise in the 1990s. It rose quite a lot, and it got up to around 70%. It fell then, and then in the crisis that we saw, the global financial crisis, you see a sharp uptake there, Q3 07, and it starts to rise like a hockey stick. And basically, around in 2012, 2013, it was up around 1 for 1. which is absolutely incredible, even by historical measures. Now it's gone parabolic yet again. And you can see that the US federal debt now is up at 23, actually more, $25 trillion.
Well, yeah, maybe if
Um,
I just flick over to this, it just gives people an idea. This is the US debt clock, and that is the number of the US national debt at this moment, the official number at this moment in time. It's just gone over 25 trillion, and you can see the speed there that it's going up. It's going up by a million about, I don't know, every 10 seconds or so. It's a phenomenal number.
it's just incredible. And if you look at it, it's utterly unsustainable. And we're now talking about helicopter money. There's checks landing in the post boxes of Americans all over the world. Free money, it's printed money, it's gone straight into their bank accounts. You can understand the rationale for trying to maintain some sort of economic stability and helping people so there's no panic, and I can understand that. But this is a long-term trend. This is basically the failure of politicians to manage the economy. They are paying the bills of today with the money of tomorrow. It undermines the the social contract that we have in the democratic and capitalist world, where is you work hard, you get qualifications, you risk capital, you innovate, you take risk, and you get a reward. And what they're doing here is they're saying, well, after you take all those risks and after you get a reward, we're going to print money to pay the bills because we're not prepared to tax you like we should, or we're not prepared to rein in spending like we should. And so when you do have crises, they do come along. You don't have the firepower necessary to extinguish the fire. In fact, what you're doing is you're undermining those very fundamental tenets that we all believe in and vote for and expect. And so this is what I mean. I think it's just shocking. I think this has gone like a hockey stick. This means that ultimately the US dollar will fail.
And sorry, I was just going to say, if we kind of put that in a different term, there was a phrase that you used there, which is borrowing from the future, which is effectively what's happening now. You're saying, okay, we've got to fund this crisis now with money that we will effectively, hopefully, earn in the future. The problem with that thinking is, at this moment in time, where are the future earnings going to come from? Nobody can see that, and we're at a period in time now where we have accelerated need for those investments. I mean, like we've seen this quarter alone, there's over 3 trillion in debt has been added to the US balance sheet. 3 trillion, exactly. Over 3 trillion.
Yeah.
That was a total historical debt. If you see it there, look back in 1970s, 1973, I was born, 1976, far left of that chart, you can see the debt was around 3 trillion. I mean, like, so in my lifetime, the total accumulated debt of the United States government has just been added in one foul swoop. I mean, and if we insane.
Sorry, let you in here in a second, Mark, but just one other thing there was that when we saw the financial crisis over a 3-year period, I was looking at a very interesting chart from Goldman Sachs there the other day. Over a 3-year period, it talked about how much the debt had increased, and we have dwarfed that 3-year period now in the space of 3 months. It's incredible.
It is. It's absolutely shocking. And there's very little debate about the medium and long-term ramifications of it because of the scale of the crisis in terms of the pandemic and now the economic crisis that we're facing. It's just been accepted as that was the right thing to do. And no one's thinking about the ramifications of this, particularly the monetary ramifications of what it's going to do to the value of the currencies, because everybody is saying, oh, well, we have to do this stimulus of, trillions and trillions and trillions. And it's not stimulus. In effect, what they've done is they've actually bailed out the banking sector in a matter of a month or 2 months. And as you said, David, it's fascinating when you look at the various charts out there, including this chart, but there's so many charts showing how the debt has just gone astronomical. The deficits are just off the charts, and it's not just on the government side. It's the total corporate debt, the banking debt, the financial debt is. If you look at the global, so that's the US, obviously. We have looked at the global debt and the global debt to GDP ratio over the months and the years, and I'm going to look at it again very soon. The last time we looked at it, I think global debt was 200. It depends. There's different people, different organizations have different numbers, but you're talking about 250 trillion to 300 trillion globally. and the global debt to GDP ratio, so versus the underlying economy and the value of the goods and services traded amongst the 7 to 8 billion people on the planet, it's 300% before this crisis. So now what you're seeing in this chart there, the excellent chart that Steve has shown there from the great research from Hedge, is that's been seen on a global scale, whether it be in China or the EU. Most major Western economies, industrial economies, are doing the same thing. And ultimately, they're destroying their balance sheets, which will have massive ramifications for the dollar, which is currently the reserve currency of the world. But you can see from that the dollar will no longer be the reserve currency of the world. That is never clearer now than ever before, And this everything bubble that we've long talked about for a long period of time, it's bursting before our eyes. This is actually showing that chart as well,
Yeah.
because the everything bubble was just waiting. There was an accident waiting to happen, as we know, given the scale of that globally. And now what's happening is the pandemic is the pin. And more importantly, I think the government response to the pandemic and the lockdowns and the shutdown of our economies is leading to the bursting of this massive bubble.
But this growth in debt as well, or continued growth in debt, is on the assumption that there is continued appetite for that debt. And we've seen a bit of kind of saber rattling between the US and China, even over this point, with Trump talking about potentially defaulting on some of that debt. Now, I don't necessarily think that that's something that would ever come to pass, but it might worry the Chinese, who are massive holders of this debt, particularly as the result of the US dollar being that reserve currency. And there might be a need for them, or at least they might feel that it is prudent for them to not hold so much, not add as much to their holdings, to look for other ways of holding their foreign reserves.
Sorry, I was going to just absolutely. I mean, and if you're looking at this like a central banker, you're looking at a country who holds reserves in a currency. You need to pay your bills, you need to import oil, you need to have a balance of payments. Why would you hold a currency that's just behaving like a junkie? Like it's horrendous what they're doing. They're totally undermining not only the faith that people put in the U.S. government, which is built on the backs of hardworking Americans over decades, post World War II. You're undermining the potentiality within the industry going forward to run their businesses using a currency. I mean, you're creating an inflation shock. And it's just terrible. I think that what you're seeing, just to bring it back to the beginning, is that the U-shaped recovery, which you might see after a crisis, is probably is being made look like a V-shaped recovery, which means we solved the problem and we're back to normal. And the reason it's gone V-shaped is because of this printed money. People are taking a bet. Money managers and Wall Street fund investors are taking a bet that this money is going to save the day. They're ignoring the fundamentals, the fact that the main streets are shutting down. The unemployment shock is only now being realized. Airline traffic, airlines across the world are being affected, and quite frankly, we're nowhere near out of the woods with regards to this pandemic. In my view, I know other people might think it's been overblown, but I think the minute these lockdown measures are released or eased, you're going to see a huge spike in cases, and it's going to change consumer behavior in a huge way. We got a photo from a friend of ours in Florida who went out to the bars today. They were open for the first time, and he was the only customer sitting at the bar. There was nobody else there, and it wasn't like the bar opened and people were rushing in. The consumer behavior has shifted, and it's going and it's only going to come back when we're confident in the future. And I think charts like this, short term, but not long term, it's actually undermining.
There's a phrase that I've heard a lot lately, which is that Wall Street is basically ignoring Main Street at this moment in time. And maybe it's a case that there is so much money washing around at the moment and being printed that it's finding a home in equities for whatever reason. Maybe it's for hope of the future. But does that mean, Mark, do you think that that at some stage a lot of that money decides, well, actually gold and silver might be the place that I should be sitting at this moment in time?
Yeah, absolutely. It's never been clearer than now. And the question is, do we, the L shape, the W shape, nobody knows. And it's just going to be very messy. It's not going to be any alphabet letter that we're familiar with. It could be a sort of a collapse into an L and then a W for a long period of time, but it basically means there's going to be massive volatility in markets. And I mean, Stephen's looking very much there at the recovery in the stock market, and it has been a very significant recovery, particularly in US stock markets. But it's very much in the S&P 500 and very much in the NASDAQ. The tech sector is doing very well indeed, because the tech sector is, you know, we're all working remotely, and we're using all these online applications to talk to each other and communicate with each other. So Wall Street is doing well because they've been bailed out. The tech sector is doing well because they're less economically sensitive. But as Stephen said, Main Street and you know, the SMEs, the backbones of the global economy, and most Western industrial nations are in big trouble. You know, so ultimately it is going to lead. You know, there's going to be massive volatility in all markets, but bonds are going to be not a good place to be. So your balanced portfolio of stocks and bonds is highly risky this moment in time, and that conversation has not been had, and it should be had in the mainstream now. People should be asking financial advisors, do you really think it's prudent to have 40-45% in equities, 40-45% in bonds as a balanced portfolio? It's not, and gold and silver right now, they remain undervalued despite the price appreciation we've seen in recent months. But more importantly, we did the video recently, gold 5,000, and we do that because, you know, people love the big round numbers, and we don't really want to do the price forecasts. But we know these currencies are going to be devalued. The dollar, the euro, the pound are going to be devalued versus gold and silver, and they are very undervalued. And in the market update today, we have our friend Nick Laird from Gold Charts or Us, who has some excellent charts. And in there, if you scroll down there, Dave, it's the top story there. And he basically goes through 31 different charts, looking at how gold and silver have performed, the underlying, the demand side, what's happening on the COMEX, what's happening demand, particularly in terms of ETF demand. And when you look at both gold, and there's a great story on Bloomberg today, which we have in that market update today as well. So gold ETF demand, and particularly silver ETF demand, is hugely strong. There's huge flows into the gold ETF. The State Street Gold ETF, which is the biggest gold ETF in the world, that had the best inflows in April since 2009. So the height of the financial crisis in 2009, the biggest gold ETF in the world had similar inflows just last month, and silver is seeing even bigger increases in terms of the silver flows. You know, so meanwhile the silver price has actually come down. So again, and the gold silver ratio is 100 to 1. So yeah, silver looks massively undervalued at roughly $15 per ounce. You know, the ratio is around 110 to 1, and yeah, it's very bullish. And we're struggling to get actual supply of silver in volume. You know, we can't get the 100-ounce bars, the kilo bars, even the 1-ounce coins. We struggle to get them. We can get some local Zurich, but and the premiums have gone through the roof, and that's a strong indication of it's not simply a matter of logistics and the gold. As I heard one analyst say, oh, it's just that the gold is in the wrong place, you know, and so it's purely a matter of getting the gold on the planes and getting it into the right place. It's much more serious than that, because the pandemic has actually impacted production in some of the gold and the silver mines, and in terms of getting the gold and silver from the mines into the refineries and the mints. Some of the refineries and mints shut down production for a period of time. Some of them have come back, but most of them have come back. And what they're doing is they're focusing very much on refining and fabricating the large bars. So very large gold bars, the 400-ounce gold bars, the kilo bars, and the 1,000-ounce silver bars. And that means there's actually continue to be supply issues for 1-ounce coins and indeed the smaller coins and bars, you know.
This is all at a price.
It hasn't been any more bullish. I don't think it's even, Dave, I don't think it's as bullish. I don't think it was as bullish as this even in 2009.
Yeah, but I'm just saying this is even at a price that's still, as of yet, is 10% below the all-time nominal high. So exactly. If we see a breakout above that 1900 odd level, we could see an awful lot of new buyers coming into the market. That would probably suggest that sentiment has really gone bullish on gold at that stage. It would be a real marker for a bullish move higher on gold, and all of those things are going to be further compounded.
Yeah, exactly. Absolutely. And the question is when, and who knows, in the short term we could go lower. So it's always important to prices fall as well as rise, but in the short term, and there is manipulation in the futures market, as we know, and we're going to see massive volatility, and gold and silver could fall in the short term.
Sure.
Gold has had a nice move up. But
there's always going to be those that have a vested interest in it not going past that all-time high for as long as they can attempt to manage that.
Well, it's all about maintaining faith in the dollar, and they don't want gold prices going $2,500, $3,000 a bid. So they'll do all that they can.
Because it just becomes the canary. It just becomes the canary in the coal mine that is no longer singing. With respect to the dollar, it's showing that we have got serious systemic issues.
It does, and by manipulating it, it actually creates a false sense of security for people, because some people say, oh, well, look, gold hasn't hit record highs, therefore that means we don't have a currency crisis, there's no risk to the dollar, so no one's talking about the risks to the dollar. It's not in the mainstream narrative at all, in the mainstream media, despite, America has never been more dysfunctional, and we've touched upon the Trump presidency and the massive division over there. It's civil war politics, we head into election season over there. It's going to get very, very messy indeed, and the economy looks like it's going to collapse in America, so it's terrible, that it requires a crisis for gold to go up and silver to go up, and we don't like being the bearer of bad news, but unfortunately that is the reality of the outlook we face, and people just need to protect themselves and protect their families and their companies.
But also just in terms of the key is also that there's a lack of resilience in the U.S. economy. You have an awful lot of people who are paycheck to paycheck. There's a huge inequality in terms of who owns assets, and where they earn money, and the stability of the average family, household balance sheet, and so what's happened is the financialization of modern economies, in particular America, in the breakneck speed that they want to develop, and the all-out rush for earnings and earning seasons and whatnot. They've actually undermined the fundamentals of their own economy, and it's terrible, because it's the middle class and the poorer people who are going to take the brunt of this, because they don't have really any kind of stability in their household balance sheets. And so when this all works out, when the civil war politics that you're talking about comes to bear, that's where the pain's going to be felt. It's terribly sad. You're seeing it in a lot of different statistics in terms of food stamps, in terms of people who die from COVID. They're typically the poor. They're the less fortunate people, and they're the ones who are going to be left behind. And it's not of their making, and it's a really sad indictment of modern systems. And it's not capitalism, and not at all. It's some I don't know, monster that's been created through financialization and hyper interest rate management. A lot of these markets are very, very fake, and they don't represent reality. And where precious metals comes into it is it kind of empowers the individual investor. It takes that as a term we've used before, personal sovereignty in this crisis and what's to come. By owning precious metals, you have that hedge that will allow you to weather these storms, or at least help weather these storms going forward. And that's why people look for metal outside of the bank system, stored in proper vaulting facilities.
Yeah. I mean, just take you up on something there, Mark. You're saying, right, you don't like to be the bearer of bad news, but I think the way a lot of subscribers look at Goldcore and the information coming from you guys is that, well, the news is out there. You just need to know where to look for it, be able to put it together so that you can see the patterns, what's actually happening, and that allows people to plan. It protects them. It helps prevent the destruction of their own personal wealth. It's not all about money, but this is, we're living in a day and age where we need to provide for our families. We need to look after our health. We need to provide for our children, for our future. That all takes money. And if you are aware of these developments, which aren't necessarily hitting the mainstream medium, that actually allows your subscribers and your clients to be better positioned. And that's really, I suppose, what you guys are all about.
That's the raison d'etre. Since 2003, our mission statement is protecting and growing the wealth of our clients. So yeah, and so there is a lot of bad news out there, but our clients, you know, they have peace of mind because they know they've done the right things. They've actually taken the steps they need to protect their wealth, and they know they'll be able to provide for their families and their companies in these worst case scenarios. So you're absolutely right, David. It's about, you know, distilling, you know, being able to look at the negative news, but you're seeing out through the other side because we've looked at some of the potential solutions, you know, and it is, as Steve said, it's that repatriation. It's becoming your own central bank. It's if you own gold and silver in the safest way as possible, then you are much more independent. You're financially independent. You're financially free, you know, and monetarily independent. So you're not dependent on the banks and the governments and the entire system, which is very unstable indeed.
Well, we'll continue to try and connect the dots for our subscribers and clients alike. We do that. We're doing that at the moment through all of these live video updates. We're going to have a podcast that'll be coming out next week. So make sure that you're subscribing to our channel and click the notification bell so that you are made aware every time that we're releasing something new. I'm sharing just there at the moment today's market update if you want to go and have a look at those 31 gold charts. But if you want to stay up to date as well, just on the right hand side of the screen there, you'll see the subscribe now, and you can get this research delivered directly into your inbox. There's a market update that goes out every day, full of all this type of content. We write our own content. We gather content from around the world, around the web, that we deem as being relevant and stuff that people are going to be able to make decisions on, connect the dots themselves, see what we're all about as well. But subscribe to our market update there. Subscribe to our YouTube channel. Share this with people that you think are going to benefit, that you want to benefit, to be able to protect and their wealth and their families' futures on into the future.
Yeah, can I say something there, Dave? Also, just thanks to Nick Lard for his amazing work at Gold Charts R Us. If anyone's interested in his work, you should sign up there at his website. He does some really, really great work. It's a huge asset to the industry, and also obviously hedge as well is a good resource as well.
Super. All right, gents, I think we'll leave it there for today, and we'll see everybody again on another live market update in a couple of days' time. Thank you very much.
Thanks, everybody.
Thank you, everybody. All the best. Be safe.
Take care. Bye-bye.